Myles, what a wall of worry we're climbing. What is your target for the Dow looking out a year?
Our target for the Dow, actually, our year-end target is just north of 1,400, something like 1,410.
On the S&P?
Where we expect on the S&P 500 is where we expect the market to get to.
So some optimism there. Does earnings help out? What is the why of we get there? Is it multiple expansion, or is it actual earnings surprise stronger?
Well, those two go hand in hand, really, when you think about what drives multiples. Is you tend to get a multiple expansion in periods where you get positive surprises. I would say this quarter, I'm a little concerned going into next week and the earnings season, how it's setting up, because we've really had 3 tough months of economic data, and we've also at the same time seen analysts raise their estimates. So I'm a little worried, in the very near term. I'll be looking for guidance, obviously, from companies like everyone else will. But I think as we work through this, positive growth will prevail and push the market higher.
Let's bring up here chart 7, if you would, here, the Dow across 9 decades. This is a long-term chart. We've shown us a lot, semi-log. Myles, are we in an equity environment that's range-bound from, say, 65 to 75, or the recent range-bound we've had? Or do you really feel there's some steam to equity valuations over the next 1 to 5 years?
That's the million-dollar question. Our operating environment is still, like many now, we've been in a bear market. We've been in a bear market for 10 years. My sense is that we're not out of this structural or what we'd call a generational bear market. So I think what we have to do is we have to be much more sensitive to the economic cycles and play them accordingly. I don't think buy and hold is still the strategy at this stage.
Okay, let's switch to financials, and then I want to get to tech that you like so much. RBC Capital Markets, here's a research note approaching the end of tumult. Credit growth has to outpace GDP growth for financials to come back. Your call on financials, it's pretty grim, isn't it?
It really is. I mean, if there's one, troubled sector out there, and it has been for a while, basically they led off the March lows in 2009 and have really been dead money and a little bit worse than that since maybe December 2009. And our thought on this is really it's a reflection of historical similarities where you saw, for example, in the mid-'70s, the Nifty 50 stocks, Coca-Cola, led on the upside, then on the downside, and was range-bound for 8, 9, 10 years. The same thing happened to technology in the last decade. And we think financials are mimicking that pattern very much so. And, when you look back at these patterns, though, Tom, the two things that really stand out is either the industry in question is suffering from a valuation excess, which I can't say financials are,
right,
or a capacity excess. And I think it's about capacity with the financial system.
Banner that, Rex. That's really important. Zyblock says capacity excess in banks. That's something to chew on. As is this chart. This is the Coca-Cola analogy. Zyblock, banks in the penalty box. The problem with charts, folks, is they're ex post. You're always looking backward after the fact. Imagine if you were in the middle of that Philadelphia Semiconductor Index in, say, 2004, and you're going up. And maybe you think you're going to go higher. And Myles, you get into that penalty box, that trading, not trending trend. How do you know when an industry group like the financials finally is ready to break out?
I think one of two things, and I'll lean on my technicians for the first part of the answer and on my own macro analysis on the second. The first is when you literally break these what are called long base patterns to the upside, that's when you have to start adding money to the sector. You're absolutely right, Tom. For example, technology through a good chunk of the last decade, these were violent swings, and they were painful, and they gave people a lot of heartburn because they would, these stocks would go up 20, 30% in a few months and then give it all back and do the same thing over and over again. When you're living that in real time, it is not easy. So again, simple rule of thumb, at least from our technicians who've studied these long base patterns going back to the 1900s, is that you wait till we break out of this base, is number one. And number two, from a macro perspective, if I feel or see if there's any indications of, keeping it very simple, what is the key or the fundamental driver for the banking system? And it's credit growth.
Right.
And like in the 1930s, if you get some indication that credit growth is coming down the pipeline, you have to start getting more interested in the banks.
Okay, well, we show the Philadelphia index there. You like tech. Why do you like tech? Bring up that SOX index again, if you would. Chart number 6, Rex, if you could. It's a CCRIL. Zyblock Banks in the penalty box. It's Philadelphia Semiconductor Index. Why now for technology? And is it semis or is it something different?
Good questions. Well, firstly, on the tech sector as a whole, the tech sector, is breaking out of that long base, and basically they started doing that in 2007, 2008. The sector as a whole. So that's the first indication. I think the other sort of long-term positive stories on tech are, they're getting no credit for the quality of their assets in the sense that they are now trading at or below the market multiple. They have the strongest balance sheets in the business. They are very shareholder friendly, second in repurchases, fourth in dividend growth over the last year. And at the same time, if you really do believe this sluggish growth environment is likely to persist, I think the companies in the tech space offer a lot of the tools that corporate America will need to maintain productivity.
Well, I like that. Earlier this morning, folks, on Bloomberg Surveillance, 7 to 10 a.m. Sirius, I think it's channel 113, Sirius XM 113. I spoke with Michael Vogelzang of Boston Advisors, and I asked him if there's a new playbook for corporate executives.
There's the old phrase, history doesn't repeat, but it rhymes. I guess a quick answer to your question is, yeah, the rhyming seems different this time. And so I think it's partly by sort of the efficiency and productivity of the economy and by corporate America. We've certainly seen that. I think it's as much, however, driven by the fact that this is a global world.
Michael Vogelzang earlier this morning. Myles Zyblock, are executives different this time? Are they managing cash flow different? Can we actually say there's a new religion out of the MBA programs into the corporations? Is business being done differently post-crisis?
I really think it is. I mean, this is one of the probably most ferocious, the last one we lived through, the most ferocious downturns that at least I've ever lived through, for sure. And at the same time, what you saw with corporate America was a very disciplined response, in my opinion, to the downturn. In fact, margins never dropped nearly as much as you thought they might have. And I think, again, it's just capital discipline that has really entered the minds of managers this time or this cycle versus, say, the last several cycles.
Myles, sector selection doesn't matter. We're all passive here. No, we're not. There's a chart. Bring it up. It's an elegant chart. Financials, white line, industrials, yellow line, normalized back 5-6 years. Look at the difference there. I mean, I know you're going to tell me sector selection matters because that's how you put food on the Zyblock table. Have you ever seen it matter more than now?
No, actually, no. The diversity in sector performance, even with an uptrend in the market, the diversity in sector performance is quite outstanding. So obviously, if you had the foresight to pick companies in the industrial sector and stay away from companies in financials, for sure. I mean, you would have hit a home run. There's no question about it.
Very good. Let's leave it there. Myles Zyblock, thank you so much. RBC Capital Markets.